A 25-year-old walks into an insurance agent's office. 45 minutes later, they walk out agreeing to pay $240 a month for something they could have gotten for $18. That is not a typo, and it is not an exaggeration. That is a 12x markup. And here is the part that should make you angry. Both products do the exact same job for the next 20 years. The only difference is that one of them makes the agent rich and the other one makes you safe. Stick around, because by the end of this video, you will know the exact phrase to say to any insurance agent that immediately exposes whether they are trying to help you or harvest you. And I will show you the specific 20-year lock that covers your highest risk decades for 96% less money. All right. Let's start with what life insurance actually is, because most people get this wrong right out of the gate. Life insurance is not an investment. It is not a savings account. It is income replacement. That is it. If you die and someone depends on your income, life insurance replaces that income so your dependents do not get financially destroyed on top of emotionally destroyed. That is the entire product. That is the entire purpose. Now, when you are 25 to 45 years old, you are in what economists call your highest human capital years. That is a fancy way of saying you have the most years of income ahead of you, which means if you die, the most income gets lost. This is also the period when you are most likely to have dependents, kids, a spouse, maybe a mortgage, maybe aging parents. So you need coverage during this window. Specifically, you need what is called level term life insurance. Here is how term life works. You pick a coverage amount, say $500,000. You pick a term length, say 20 years. The insurance company says, okay, if you die during those 20 years, we pay your beneficiaries $500,000. Your monthly payment stays exactly the same for the entire 20 years. It never goes up. For a healthy 25-year-old, $500,000 of 20-year level term costs about $18 to $25 per month. Let me say that again. $18 to $25 per month. Half the cost of a streaming subscription for $500,000 of coverage. Now let's talk about what the agent wants to sell you instead. Whole life insurance, also sometimes called permanent life, universal life, or variable life. They have a lot of names for it. That should be your first red flag. Whole life insurance combines a death benefit with a savings component called cash value. The pitch sounds amazing. You get coverage for your entire life, not just 20 years. Part of your monthly payment goes into a savings account that grows over time. You can borrow against it. It sounds like a 2-for-1 deal. Here is what they do not tell you. That same $500,000 of whole life coverage costs approximately $240 to $350 per month for a 25-year-old. We are talking 12 to 16 times more expensive than term. Now the agent will say yes, but you are building cash value. You are saving for the future. It is forced savings. Here is why that is a financial trap. In the first several years of a whole life policy, the vast majority of your monthly payment goes toward fees, commissions, and administrative costs, not toward your cash value. The agent's commission on a whole life policy is often 80 to 100% of the first year's premiums. Let me translate that. If you pay $240 a month, that is $2,880 per year. In year one, the agent might pocket $2,000 to $2,800 of that. That is why they push it so hard. They are not being evil. They are responding to incentives. The system is designed to reward them for selling whole life, not term. Now let's do the math that the agent will never do in front of you. If you pay $240 a month for whole life and you could have paid $18 a month for term, the difference is $222 per month. That is $2,664 per year. Over 20 years, that is $53,280. Now here is where it gets painful. If instead of handing that $222 per month to an insurance company, you invested it in a low-cost index fund averaging 8% annual returns over 20 years, do you know what you would have? Approximately $130,000. Meanwhile, the cash value on a whole life policy after 20 years, on a $500,000 policy with $240 monthly payments, You would typically have somewhere between $25,000 and $40,000 in cash value. Maybe. And if you ever want to actually use that cash value, you have to borrow it. Like a loan that you pay interest on. Let me make sure you heard that. You give them your money, they give you back access to your own money. As a loan. With interest. This is why Dave Ramsey calls whole life insurance a ripoff. This is why Suze Orman tells people to run from it. This is why almost every independent financial advisor who is not selling insurance says the same thing. Buy term. Invest the difference. Now. Let's talk about the specific strategy because knowing the problem is useless if you do not know the solution. Here is what you do if you are between 25 and 45 and someone depends on your income. Step 1. Figure out how much coverage you need. A simple rule of thumb is 10 to 12 times your annual income. If you make $60,000 a year, that is $600,000 to $720,000 of coverage. Step 2. Buy a 20-year level term policy for that amount. Not 10 years, not 30 years, 20 years. Here is why. 20 years covers you from the point where you have young dependents to the point where those dependents are financially independent. If you are 30 with a newborn, a 20-year term covers you until your kid is 20. By then, they should be in college or working. Your mortgage should be smaller. Your retirement savings should be larger. You need less insurance, not more. Step 3. Take the money you saved by not buying whole life, that $222 per month, and invest it automatically into a diversified portfolio, index funds, ETFs, your 401k, whatever. Just do not hand it to an insurance company. This is called buy term and invest the difference. It is not complicated, but it requires you to say no to a very persuasive person who is trained to make you feel irresponsible for not buying whole life. Which brings me to the phrase I promised you at the beginning. When an agent starts pushing whole life, ask them this. What is the internal rate of return on the cash value, net of fees, compared to a 7% market benchmark over a 20-year horizon? If they cannot answer that question immediately and transparently, they are not advising you. They are selling you. Here is what typically happens. They will pivot. They will say something like, but this is guaranteed. The market could crash. What about 2008? And yes, markets crash. But over any 20-year period in the history of the S&P 500, there has never been a negative return. Never. Not once. Meanwhile, the guaranteed return on whole life cash value is typically around 2 to 4%, before fees. After inflation, you are barely breaking even. Sometimes you lose ground. So let's zoom out and look at the full picture. Path 1. You buy whole life at 25. You pay $240 a month for 20 years. That is $57,600 in premiums. Your cash value after 20 years is around $30,000 to $40,000. If you die during those 20 years, your family gets $500,000, which is the same thing term would have done. Path 2. You buy 20-year level term at 25. You pay $18 a month for 20 years. That is $4,320 in premiums. You invest the $222 difference monthly at 8% for 20 years. You end up with approximately $130,000 invested. If you die during those 20 years, your family gets the $500,000 from the policy plus whatever is invested. Same death benefit. One path costs $57,600 and leaves you with $35,000. The other path costs $4,320 and leaves you with $130,000. That is a $95,000 swing on the exact same income with the exact same death benefit. This is why I said 96% less. The term policy costs 96% less than the whole life policy for the same protection during the years you actually need protection. Now, one more thing the agent will say. They will tell you that after 20 years, the term policy expires and you have nothing. No coverage, no cash value, nothing to show for it. This is technically true, and it is also completely irrelevant. Here is why. If you follow the buy term and invest the different strategy, by the time your term expires at age 45, you should have approximately $130,000 invested. By age 50, that could be $200,000. By retirement, well over $1 million. At that point, you are what insurance people call self-insured. You do not need life insurance because your dependents can live off your investments. You have become your own insurance company. The whole life policy, by contrast, still wants $240 a month from you at 45, 55, 65, forever, or until you surrender the policy and get hit with surrender charges. So here is the summary. Life insurance is income replacement, not an investment. Buy 20-year level term for 10 to 12 times your income. It costs about $18 to $25 a month if you are young and healthy. Invest the difference between what whole life would have cost and what term actually costs. By the time the term expires, you should have enough invested that you no longer need life insurance at all. And if any agent tries to sell you a policy that costs more than your car payment, walk away. They are not protecting your family. They are protecting their commission. If this was helpful, there is more on the channel. Hit subscribe for more videos that break down financial concepts without the industry spin.